hope you have your 3 different alternatives in front of you. In this video, we will look at the first of the 3 alternatives. Very important, this is with regards to the reclassification from IAS 16 to IFRS 5 and how to interpret the reclassification. You must be able to do all 3. The first one will be how we as a university interpret the standard. The second one is how Gripping GOP interprets the standard. And the third one is another interpretation. All 3 you should be able to do. As we can tell you, the accounting policy is the same as, for example, number 1, 2, or 3. So we as a university, we interpret the standard as we will, on the date of the classification, transfer the carrying amount of the asset out of IAS 16 to IFRS 5. And then immediately after that will we do an impairment test to see if the asset is not maybe impaired. So you can read here the requirement to remeasure assets in accordance with their own standards before reclassifying to non-current assets held for sale in terms of IFRS 5 paragraph 18 only means that the assets need to be depreciated up to the point before the reclassification. Thereafter, IFRS 5 is applied directly. This is our assumption. Assets previously under the revaluation model will not be revalued before applying IFRS 5 because revaluations would normally only be performed either the end or the beginning of the year, but not some time during the middle of the year when the asset satisfied the criteria. Also, the impairment indicator triggers IFRS 5 specifically because the asset will be sold at a lower fair value. So it's irrelevant to apply IAS 36 first. So first, we'll take it to IFRS 5 and then do an impairment test. Let's look at an example. We have a property, it's PPE, carrying amount is 500,000. Cost 1.2, accumulated depreciation 700, and we met the criteria on 31st March 2014. On this date, we will now take it out of PPE, bring it into IFRS 5. My year end is 30 June. Property was previously carried under the revaluation model. NRV method. Balance on the revaluation surplus on this date was 40,000. Fair value of the property on 31st March 2014 is 410. Fair value less disposal cost is 320 and value in use is 370. It's our policy to reclassify our revaluation surplus balance on assets classified as held for sale to equity associated with assets classified as held for sale when the assets are reclassified to IFRS 5. So then they ask us for the journal entries. So first journal entry will be I'll transfer my carrying amount on the date of the reclass to IFRS 5. So my non-current asset held for sale will be 500,000 and I'll eliminate or take out my accumulated depreciation and my cost. This was given. Immediately afterwards, I'll do an impairment test. My carrying amount is 500. Fair value less disposal cost is 320 given, and my impairment is then 180. Can you see I'm not using a recoverable amount, which will be the higher of value in use or fair value less cost of disposal, because I'm not going to use this asset anymore. My impairment loss will always go through P&L in IFRS 5, even though I was on the revaluation model before, and my revaluation surplus will be transferred to equity associated with assets classified as held for sale, the 40,000. In the next video, we will look at the other alternatives.